And welcome to another episode of the Bull and the Bear podcast. I'm your host, Matt Clark. Glad you're with us as we are each and every time we do these. We usually try to do about 2 a week, giving you safe and profitable investment advice. So certainly glad you're with us. Just to kind of clear things up right away, if you don't already know, you can listen to us on various podcast channels, various podcast syndicators, ranging from Apple Podcasts, Google Podcasts, Spotify, iHeartRadio, many others. You can also see this video. We record this as a video as well, and you can see that on YouTube. Just go to youtube.com and do a search for the Bull and the Bear podcast, and there you are. You'll see all of our videos on our channel. We have several podcasts and much more. So by all means, and you can leave us a comment, leave us a review. If you have any questions, email us at thebullandbear@moneyandmarkets.com. That is the easy way to shoot a question over. If you have maybe something you'd like our chief investment strategist, Adam Odell, or myself, or Charles Sizemore to discuss in a podcast, by all means, man, let us know and shoot us a message. And we are more than happy to take that feedback and take those questions and go with them. So as you can see, if you're watching on video, a little bit different today. I want to detract a little bit, but I'm actually recording from home today. So that's kind of nice. Of a brand new banner. I'd like to shout out to our graphics department for getting that put together. Looks very nice. But to dive right in, let's get right into it. And today I want to talk about dividends. I used to be very bullish on dividend stocks, and there's a good reason to be. You're always looking when you're making investments. You're always looking to try to find ways to make money. That's why you do it. You don't enter the stock market with the intent of losing money. If you do, then I have many other ways you can do it, including sports books, casinos, many other ways you can lose money that are less intensive as the stock market. But one way that investors look at not only preserving capital and realizing small returns is to invest in dividend stocks. Now, just to give a brief refresher for those of you who don't know what dividends are. Dividends are basically paid out by publicly traded companies. They're basically rewards to investors for investing in their company. And they can be paid out quarterly. They can be paid out yearly. They can be paid out every 6 months. There are some out there that actually do pay monthly. It's rare, but there are some that do. And they're paid out based on the profits the company earns. So basically when a company earns in excess of what it spends, it can take some of those profits and then in turn give that back to shareholders in addition to whatever premium the shares are worth that a shareholder can realize. So it's a nice way, it's a nice secondary source of stock income, if you will. And I'll bring on Charles Sizemore, our contributor, here in just a second. He may correct me to see if any of my points are a little off there. But to me, that's a very simplistic way of explaining what dividends are. And there are very large companies that do pay good dividends. They pay solid dividends. But you have to be very careful, though. And we're going to talk about this a little bit before we get into the meat of our podcast, because there are some dividends. Dividends are not all created equal. You have companies that pay dividends. They either keep them flat, they can move them up every year, or some actually move them down if it's slow. But there are some companies out there, and I found this out, that there are some companies out there that will pay what appear to be very handsome dividends, whether it be 20 cents a share, 15 cents a share, 50 cents a share, $1 a share. They will pay those handsome dividends, but they're only doing it to keep investors enticed in buying the stock. They're not doing it because their profit line suggests that they should do so. And this is kind of a poor business model to look at, and it probably makes for a very poor company to invest in. Now, to give you an overview of what we're going to talk about, I picked out 3 stocks that are very solid dividend stocks in terms of what they pay out. They have kind of low yield, but they do pay out pretty decent dividends. And we're going to talk about each one of those 3 stocks. And Charles and I are going to give you our take on what we think, whether these are companies you should maybe look at investing in or the ones that you should maybe shy away from. So I want to bring in Charles Sizemore, Money and Markets contributor. First off, Charles, welcome from the great state of Texas. Glad to have you on this podcast. And I talked a little bit about what dividends are and discussed kind of the pratfalls of some dividends, some kind of nefarious companies that do dividends, a little shady. But give me your take and talk about dividends in general.
Well, so I would actually take a slightly different take on that. I would say dividends are actually a protection against nefarious actions by management. And what I mean by that is, management has this, of every company, has this intense pressure to, beat their quarterly, whatever analysts expect the company to do that quarter, they have this incentive to beat it by a penny or, whatnot. They have this incessant need to meet expectations or exceed it. That really incentivizes them to, I don't want to say cook the books because that sounds illegal, but it incentivizes them to be a bit aggressive on the accounting. And so even if you're not doing anything that's, strictly speaking, wrong or illegal, you can certainly be slightly misleading investors and setting them up for failure if you're doing things like recognizing revenue aggressively, being offering more generous credit terms to try to, get a sale, even if you don't collect the cash for, a couple quarters into the future. All of these things can distort earnings. Well, dividends, they force management to be disciplined because at the end of the day, they're not just some book entry, they're cash. Management has to produce the cash to give it to the investors. They can't just say, hey, our earnings were, X, Y, and Z this quarter. And that's great. They actually have to produce the cash to back that up. So I just philosophically, I love dividends because they create, in my opinion, a better kind of company with a better kind of management. Beyond that, it also puts management in their place. You don't want the imperial CEO that runs the company for his benefit or her benefit. You want someone who thinks about the shareholders. At the end of the day, they're not the boss. You, as John Q. shareholder, are the boss. They work for you. He may make more money than you do. He may drive a nicer car, whatever, but that CEO works for you if you're the shareholder. And so the way that they can show that they are looking after you, the shareholder, is by paying you that dividend every quarter or every month, every 6 months, whatever. By paying you that regular dividend, it's a nice, lucrative thank you note to patient investors. So I would say, it's, as a general rule, the payment of a dividend is very much a protection against bad management. I would say where it can get a bit, like all things in moderation, right? Where dividends can become problematic is when management has this incessant focus on yield at the expense of all else. If their identity revolves around meeting a certain yield or certain payout expectation, they can make bad decisions on that. They could end up taking out more debt than they should. They could end up underinvesting in growth. You don't want a management team that's so obsessed with meeting that dividend that they let the company crumble around them in the process. So you do have to watch, make sure that dividend that's being paid is actually supported by real cash flows and real earnings. But as a general rule, I would say, the existence of a dividend is a very nice positive.
It is, and I think a lot of investors look at that. If you're looking at retirement investing, things like that, that's a good way to not only bolster your returns but add capital to whether you reinvest those dividends into buying more stock or whether you take it outright. However you choose to do that.
You make a good point about retirees. One of the biggest problems with stock ownership is that let's just pick a stock at random. Amazon.com. One of the greatest growth stories of our lifetimes. Fantastic company, visionary leader, et cetera, et cetera. Well, let's say you've been riding the stock up for years. The only way, you got to live, right? You still got to eat. You got to pay your bills in retirement. The only way you can realize any of your gains from that stock is to sell shares. And if you sell your shares, then you have fewer shares left to compound over time. So the nice aspect of a dividend is it allows you to realize a gain along the way, so you don't have to sell your shares. That's one of the reasons I really wish some of our big tech companies would be a bit more generous in the dividend front, because I think these are great stocks to own. I don't think you should be forced to sell them to pay for your retirement needs, but that's a longer conversation for a different day.
It is, and the one thing to keep in mind is that it's the company's prerogative to pay a dividend. There's no requirement. Nothing suggests that a company has to pay a dividend. It's a company that chooses to pay it, and they make the determination based on the profits on what that dividend will be. Okay, so we'll touch on this a little bit as we go into the conversation. But there is a difference between investing for dividends and investing for yield, and I do want to get into that here shortly. But I want to jump into these three companies first. I found three companies. They're not in a related sector. They're not they're not competitive of each other or anything like that. They're three separate companies, but they all do pay a dividend and have paid dividends for a long time. So not only are we going to look at the dividend aspect of it, but I also want to look at kind of the factors related around the stock to make an overall decision, because you don't want to make a decision to buy a stock solely based on the dividend or the yield. That can't be your only rationale for buying. You've got to factor. It's just like using one technical indicator to decide whether you want to buy or sell a stock. It may work, but it's probably not the best approach. You probably want to incorporate different factors and maybe even some fundamental research in before you decide to buy a stock, not just taking one thing and using that as your basis and your mode. I mean, I will only invest when the company hits the golden cross or something like that. Yeah, you want to be a little bit more robust with your methodology than that. So the first company that I found here is a company that produces medical and scientific imaging. It does RF technology and other software. It's a good size company. It's not a small company. None of these are, by the way, and you won't see a lot of small cap companies paying dividends anyway. They're mostly reserved for large cap, mega cap. To an extent, some mid caps may pay dividends, but it's pretty rare. And this is Roper Technologies Incorporated. It trades on the New York Stock Exchange under ROP. In terms of its dividends, it did recently in Q1 raise its 2020 dividend to 50 cents per share. And that's up from 46 cents a share it paid in the previous quarter. That 46-cent dividend was held throughout 2019 and was actually a raise from 41 cents per share it paid in 2018. So the trend here is that you see it started at, and you go even farther back, but I'm just taking the last couple of years. But in 2018, you're at 41 cents, and they bump up a nickel to 46 cents, and then up 4 cents to 50 cents a share in Q1 of 2020. Now in Q2, where economic situations may be different, there's no telling what they're going to do with the dividend. This is just the most recent dividend data, so you have to kind of factor that in. It's got a 1-year dividend growth rate of about 12%, just a touch over 12%. And I'll start by asking you, Charles. You've had a little bit of time to look at this company as I gave these to you yesterday. And first off, give me your take on Roper Technologies and how its dividend has paid out.
Well, the first thing I'll mention is it sounds like a boot company. Now, maybe that's the Texan in me, but when I see something called Roper, I just assume it makes boots.
Because you're thinking Roper boots.
I was. That's immediately where I went. But that's not at all what the company does, clearly. I think they are interesting for a couple of reasons. One, they have a really long history of raising their dividend. They've been raising it since 2009. That's a really nice long streak. One of my favorite expressions, and I don't know where this expression came from, but I'm just going to appropriate it as my own now. I invented this quote. Was the safest dividend is the one that's recently been raised, because if management, what is management doing when they raise a dividend apart from just obviously giving you more money? They're sending a signal. They're sending a signal that we feel good about our business. We are confident that we are growing, and we are comfortable parting with more money. Because think about it, every time a company pays a dividend, that's money that is out of the company's bank account and into yours. They never get that dollar back. It's gone. So you don't pay out money as dividends that you think you might need to pay the light bill next week, right? So when a company makes a decision to raise that dividend, that is a big showing of confidence. So, and Roper can back that up. It's a company that has a specialized niche. It seems like they're fairly COVID-19 proof for the most part. They have they're more of a gritty kind of industrial company that they make software and hardware, but it's not the sexy consumer facing stuff. This is all kind of nuts and bolts type stuff, which is good. That's exactly what I like to see in a nice long-term dividend payer. The yield isn't exceptionally high right now, but that's okay. If you look at competing, look at what bonds yield these days. Bonds yield practically zero. So it's not realistic for us to expect stock dividend yields of 3, 4, 5% across a diversified portfolio. You may have a few stocks that yield that for sure, and there's nothing wrong with that. There's everything right with that. But I think a lower dividend yield around the 1% mark or whatnot is actually not a deal breaker in a world where bond yields are practically zero. So overall, I like Roper. You don't really buy it because you expect some massive windfall check in your mailbox every quarter. You buy it because it's a consistent dividend grower. It's a healthy company, and it's largely off the radar screen of most investors.
I will tell you, just I'm looking over here at my screen on some of the other ratios and whatnot. In terms of against the industry, and this is a software specific industry, or specific software industry rather, its ratios are relatively solid compared to the rest of its peers, and its return-ons are very, very good. You're looking at an industry that has negative return-ons both in assets, equity, and investment, whereas Roper is positive across the board. It's a relatively, I would say, I don't know that I necessarily say it's undervalued, but I think it's valued about right. Its PE ratio is much lower than the rest of the industry, but the rest of its price to sales, price to cash flow, and price to book are a little lower than the industry average. But yeah, I'm not necessarily concerned with a lower dividend yield. Its forward dividend yield is 0.5%. I'm not necessarily concerned with that because I think you're right. I think you buy a company like Roper not because you're not buying it for the dividend, you're buying it for the company,
and because you like the boots.
Yeah, and the boots, which it does not do, by the way.
Which it does not do.
So I would have to say that Roper, to me, if you're looking at the stock overall, is a strong buy. I say a buy, not a strong buy, but a buy. And I think the dividend just adds a nice icing to that to that buy. In
a diversified dividend growth portfolio, a stock like this clearly has a place. Software has been one of the best industries to be in for the last decade. At the end of the day, I don't see that changing tomorrow. So I would agree.
Good deal. We'll move on to our second stock. The second one I picked. This is one that I have a little bit of experience with because in an article I wrote back in March, I actually recommended this company as one to buy because of what it does, what segment it's in, and how it conducts its business. And it's classified as a gold stock, but it's not really a gold stock in the traditional sense. It's not a miner. It does not own mines. It does not pay for mining. It does not do any of that. This is a company that focuses on royalties surrounding gold. So basically, it's a company that has no upfront mining costs and makes money just strictly on the gold that's pulled out of the ground. And those margins are actually very, very good. And this company has performed very well since I recommended it in March, not to toot the horn, but it's up about 35-36% since March. So it is weathered the coronavirus downturn and whatnot very, very well. And it's Franco-Nevada Corporation. Again, it's not a gold miner. You think Franco-Nevada actually kind of sounds like a really cool gold mining stock name, but it's not. Like I said, they focus strictly on the royalties of the actual gold, not the mining of it. So gold you pull on the ground, they have royalties on it, and they collect on those royalties. Much like, I don't know if it's really quite the same, but much like kind of record deal royalties. Artists get royalties on music played over the course of time, not just when they make it. So they collect pennies on the listen or whatever. Whenever every time you download a song, that artist of song you download is likely getting some sort of a small 1 cent, 2 cent, 3 cent kickback because you downloaded their song. So that's kind of how the royalties work to the best of that I have it. Now, Franco-Nevada recently raised its dividend by a penny a share. It's now up to 26 cents a share. They did that back in May. It's got a 1-year annual dividend growth. It's not really exciting. It's about 4%. So it's not a real aggressive growth in terms of dividend, but it's been a very solid dividend stock. Not only, and it's been solid all the way around, really, in terms of not just dividends, but also in the sector that it's in, because gold has already surpassed the $1,800 mark, and it's doing very, very well. So, Charles, your thoughts on Franco-Nevada?
Yeah. So, as a general rule, well, let me back up for a second. I'm trying to think of a good analogy here. There's the old expression, you can look for Mrs. Right, or you can look for Mrs. Right now. And I would say Franco-Nevada is that Mrs. Right now. It's as for a dividend stock, I don't necessarily like anything tied to commodities, because the income stream can be really volatile. That said, right now, I absolutely love anything related to gold. As we've discussed on this program multiple times, actually, I think having exposure to precious metals makes a lot of sense in an era where the Fed is printing $1 trillion a month. I think we are looking at a period of financial uncertainty, if not outright instability. And I'm not bashing the Fed. I'm not throwing them under the bus. If I had Jerome Powell's job, frankly, I have no idea what I would do. I'd probably do the same thing he did. I would just flood the market with liquidity and hope for the best. But a consequence of that, the Fed was actually successful in preventing the economy from completely melting down during the COVID-19 outbreak. But a problem with that, a long-term consequence, is that we may be looking at a prolonged period of dollar weakness, dollar instability, a lack of faith in the financial system, et cetera. All of those are very real issues. So I think having exposure to precious metals in general, anything associated with precious metals, is a great idea. If we can get paid a dividend stream on that in the meantime, great. I would add that Franco-Nevada has done a fantastic job of raising for a company that is, at the end of the day, still tied to commodities. It's been a remarkable dividend. It's had a remarkable streak of dividend increases going all the way back to 2008. I would say, as a general rule, though, I wouldn't, if I'm building a dividend growth portfolio, I would steer clear of anything having to do with commodities. But I would make an exception here for the here and now, because I do like it. Now, one other point I would make: you said that Franco-Nevada is not a miner. That's an important distinction, because even though the bull case for precious metals has been, it hasn't really changed in months. What we found was that the miners themselves were having some issues with the virus, because they couldn't get their workers. Their workers were getting sick. They couldn't meet their production goals. That was problematic. If you're really just collecting the royalty stream and not having to deal with sick workers or whatnot, that's clearly an advantage in this environment. So, kind of summing up Franco-Nevada, it's not, if I was going to buy set it and forget it, and, a portfolio of dividend stocks to just drop into a drawer and not look at for 20 years, this would not make that list. But if I'm looking at something that I would want to keep for the next several years and, make a little bit of money on dividends in the process, then yeah, sure, I would include this.
Yeah, I think that the economic situation that we're in right now warrants Franco-Nevada to be one to look at. When I recommended it, its ratios were much, much lower than they are now. In fact, compared to the industry, to the precious metal mining industry, which it is actually classified, their ratios are actually quite high. I mean, right now it's got a PE ratio of 147. I mean, so that's a really, really high PE ratio for any company. The industry average is 36. So, there could be some thought that Franco-Nevada may be a little overvalued. But then again, if you look at the entire market as a whole, everything's overvalued at this point.
There's a distinction to make there, though. And did you see that? I very, very, very slickly put that earpiece back in as it was starting to fall out. PE ratio is inherently backward looking. And so if Mr. Market here is looking forward and sees higher gold prices, then the price earnings ratio is not particularly relevant for this type of stock. Where commodity prices can be an issue, things like the PE ratio are really, really tough. Your point is noted, though. This is an expensive market, and virtually everything is a little bit pricey. The question is, do you see precious metals getting more expensive, and is a stock like Franco-Nevada a way to participate in that?
And I think for the time being, that answer is yes. I mean, and the other thing to consider is, because Franco-Nevada does not technically mine, they don't mine stocks, their return-ons are actually very good compared to the industry. The rest of the mining industry has return on investments that are actually in the negative. They're actually in the red. Franco-Nevada is in the positive. It's not by much, but it's a 34% turnaround on return on assets. It's a 36% return on equity. So, and that's a turnaround that's from the negative of the industry to the positive where Franco-Nevada is. So, I still remain very, very, very high on Franco-Nevada from my recommendation in March. I still think it's worth looking into. I think gold is well on its way to reaching even higher than it is now. I think it's going to test 1,800 and break out of it. Our chief investment strategist, Adam Odell, has talked about this, and I think he sees gold reaching up to $10,000, and I, quite frankly, I agree with him. I don't know when it's going to happen, but I think it's going to happen, and I think it's definitely worth looking at. So to me, I think Franco-Nevada is definitely worth looking at as something that I think, Charles, you're right. I think it's something to look at, 2, 3, 4 year hold, and then kind of see where things are at with precious metals and decide from there. So I agree with you there. The last company to look at here is another one that I found just kind of interesting, just because. Now, I will preface by saying this company does report earnings tomorrow, so take that for what you will in terms of whether you decide to buy the stock today or not. The earnings report does come out tomorrow, so that's just something to bear in mind. But it's a company that it makes paints and coatings, and it services various industries from automotive to aerospace, architecture. They basically kind of have the market kind of cornered in terms of how that works. So a lot of times if you look at your car, it's got a clear coat finish on it. I would say there's a really good shot that clear coat finish was, or even the paint as well, was provided by this company. And this company is PPG Industries. It's on the New York Stock Exchange trading under the symbol PPG. It raises dividend payment to 51 cents a share. It's about a 6% increase from the previous quarter. It's got a 1-year annual dividend growth rate of about 6.4%. So again, not as weak as Franco-Nevada, but also not as robust a 1-year potential dividend growth rate as Roper. So your thoughts on PPG?
I love it, actually. They've raised their dividend every year since the early 1970s. And think about how different the world was then as opposed to now. How many different economic seasons we've gone through, how many bear markets we've had. Stagflation. Then we had the disinflation of the 80s. We had the 90s bubble. We've had the 2008 meltdown, COVID. The last 40 something years here have been a wild ride, and this stock has managed to raise its dividend every year along the way. It's one of those companies that's just sort of under the radar. You never, the average consumer doesn't know the company, doesn't understand its brand pedigree, but somebody in, I don't know, works in a factory in Detroit or whatnot. I mean, this is something they would know the company. It's well known and well respected within its niche market, and they've been doing it for a long time. If any, the mark of a let me back up for a second. This is good stuff. So I'm going to butcher this to some extent, but Nazim Taleb, the Black Swan and Fooled by Randomness guy, Anti-Fragile, he had a theory he called. I'm going to butcher this. I think he called it the Lindy effect. And it was the longer a technology or company has been around, the more likely it is to be around in the future. And the idea is, okay, some, cutting edge new technology that can easily be replaced by a new cutting edge, new technology next week or next year or whatnot. Whereas something that's been around for 5 centuries is probably going to be around 5 centuries from now. I mean, obviously there's exceptions, but that was his kind of general rule of thumb. I would say something like that really does apply to a company like this. Hey, we may move from internal combustion cars to electric Teslas tomorrow. Whatever, it's, the transitions like that happen along the way, but things still need to be painted. They still need to be coded. And a company like this has proven that it has the ability to roll with the punches and change with the time. So I think this is a really nice long-term dividend payer, long-term dividend grower.
I agree. I think it has the potential to really provide solid dividends, and you hit it on the head. It's a company that's been around for a long time. It's a company that provides a service that still no one else getting into the market has been able to really dent its market share.
Who's going to start a new paint company now?
Yeah,
it's exactly. Why would you even get into that business given that the existing competitors are well entrenched? How are you? What are you going to do differently that's going to make you a better competitor than these guys?
Right.
And the answer is nothing.
You're not. You can't. There's no way to do that. The only concern that I have with PPG is more so an immediate concern, not one that I think has anything to do with its long-term stability. And that is the fact that PPG has a lot of very large clients like Ford, clients like General Motors, clients like BMW, clients like Boeing. And these are companies that have experienced pretty significant slowdowns because of the coronavirus. So what I'm anticipating here is that when they report earnings in the next day, those earnings are probably going to be off. That's a big secret.
They'll probably take a bath. Yeah, I agree. I think that's a very good risk that these guys take a kitchen sink quarter where they just
it could be ugly. So I think if
Sure.
you're going to take the recommendation that we have here and buy, and I think we both agreed that this is definitely a stock to buy, I wouldn't do it today. I wouldn't do it tomorrow. I would probably wait until next week at the earliest before you decide to jump into this, because you're probably going to see a 3, 4, 5% drop in its share price. I don't want to be one of those ones that says buy it on the dip, but it's going to dip simply because outside forces and its outside clientele have significantly trimmed back the amount of product from PPG they're using. And that's going to impact sales, that's going to impact the bottom line, and that's going to impact its quarterly report. There's no way around that, and I see that being kind of a short-term issue that PPG is going to have. Again, I still think PPG is worth a look. I still think it's worth a buy. I still think it's worth it as a dividend stock. I just don't think it's worth it right now. And by right now, I mean this week. So, and that's just my thought on it, because I just think there's a lot of headwind, and I think you're going to see that in its quarterly earnings report, which comes out in the next day. So, and that's one of the reasons why I chose it, is because I want to get your take on your thoughts with that and see what you think. So right now, it seems like the 3 stocks that I picked, there wasn't a lot of dissent here. They're all 3 ones to definitely look at and potentially buy if you're an investor. I think we all agree. Both Charles and I agree on that. I think there's different ways you have to look at how you buy it and what you do with it once you buy it. Like, for example, Franco-Nevada is probably a good one to buy and sit on for a short amount of time. And then if you start to see gold maybe take a bit of a reversal, which I don't see happening yet, then it might be you might want to cut the position a little bit, maybe tranche the position somewhat or whatever. PPG, very good long-term potential here, but you want to wait before you buy it. You don't want to buy it today. You probably want to buy it next week, maybe even a week after that at its earliest. And then Roper, very solid company. One of those companies you don't necessarily buy for the dividend, but the dividend is a nice bonus to have if you own the stock. So I think that kind of encapsulates things, yes?
Yeah, no, I'd say so. And to reiterate, Roper does not make boots.
Roper does not, in fact, make boots. I mean, there was a company of Roper that does make boots. This is just not the one we're talking about. So just to be very, very clear. In fact, I think Roper, who makes boots, is owned by a much larger company, and I don't even know who it is. So if you know out there, email us at the Bull and Bear at moneymarkets.com and let us know who that is. That way we can solve the dilemma that we have. But so those are three stocks that hopefully you can look at and make a determination. Again, do your own homework. We've done a lot of the research for you. We've done a lot of the legwork. We've given you our thoughts and our recommendations. By all means, take that and run. And dividend stocks, I think we're both pretty bullish on. Charles, maybe I think you're a little more bullish on dividends now than I am. I used to be I used to only look at dividend stocks when I made recommendations. Now I don't really do that. I look a little bit beyond that. So not saying that's what you do, but I just think that in terms of our bullish position on dividend stocks, I think you might be a little more bullish than I am.
I wish every company paid a dividend. I really do. But I would say, where my own thinking has shifted is I am more willing to look beyond dividends to, really good growth stage companies. And part of that, particularly of this past year, dividends have proven to be somewhat fragile in a lot of cases. So, I do think, you can't just say, I only buy dividend stocks. That's it. I don't buy any company unless it pays a dividend, because if you had that attitude, you would have missed out on Google. You would have missed out on Amazon. You would have missed out on Apple for years. It pays a dividend now, but it didn't always. You would have missed out on Microsoft for a long stretch of its history. Microsoft actually does pay a dividend now. But and that's, why do that? Why miss out? But
right.
All the same, all else equal, I do prefer dividend-paying stocks to non-dividend-paying stocks for all the reasons we listed. It shows that management is looking out for you. It does create a more disciplined company that has to produce the cash and can't just cook the books. And more than anything, it's just a better way of being. It's a better kind of company, one that looks out for their shareholders. So it's definitely better, but it's not necessarily the only thing you should look for, to say the least.
It's not the end all be all. And I think when you're looking at a dividend stock, it's important to look at its history. Don't look at what it's done in the last quarter. Look at what it's done in the last decade or last 5 years or whatever, to see kind of what its trend is. Now realize that, the last 5 years we've been in a pretty strong bull market. So raising dividends is kind of a no-brainer because things have been rocking and rolling pretty good. Now we're not. Now we're in a recession. We're in a bearish market, or a bearish kind of market. And the atmosphere is a little bit different now. So, but look at the trends, look at what a company does. And if it's a company that's paid even stronger dividends, look back to 2008, 2009 during the Great Recession. What did it do then? And and that might give you a bit of an indication of what you can expect for a dividend stock to do here in the coming months, in the coming quarters with the way things are now. So that we're going to put a lid on things with that. So hopefully that's given you a lot of things to think about in terms of dividend stocks, and definitely appreciate you coming on, Charles. Thank you for that. Coming up on Friday, Charles will be back. I will be back, and we will have Money and Markets Chief Investment Strategist Adam O'Dell, where we're going to find 3 stocks. I haven't figured out which 3 yet. I'm going to kind of keep that under wraps, and we're going to analyze and talk about them at length and find a sector that's trending. So make sure you come back to us for that on Friday. In the meantime, you can listen to us. You can listen to this podcast, any other podcasts that we've done on Apple Podcasts, Google Podcasts, Spotify, iHeartRadio, YouTube. Go to youtube.com and type in the Bull and the Bear podcast. We're right there. And you can also email us any comments, questions, or concerns you have. You can do that at the Bull and Bear at moneyandmarkets.com. Any one of those places you listen, make sure you leave us a comment, leave us a review, leave us a question. More than happy to take a look at those types of things. And we certainly appreciate everyone who has downloaded the podcast and listened to it or watched it on YouTube. Thank you very much for that. So for Charles Sizemore, I am Matt Clark, and this has been the latest episode of The Bull and the Bear on moneyandmarkets.com.